Good evening, everybody. Welcome to Endowus Live webinars. It's great to be back again. I'm joined today by my wonderful colleague Wei Mei Tan, who's our Chief Advisory Officer. So great to get going on this session. Wei Mei, you want to say hi?
Hi everyone. Good to see you guys again.
Wonderful. So today is a regular session, a quarterly session that we do. Endowus Q3 Market Insights and Performance Review, where we go through all of the Endowus Core Advised portfolios. So remember, we have multiple sources of funds where we build globally diversified, low-cost portfolios for our clients. And it's across CPF, SRS, but also cash savings. And so we have three portfolios. In addition, we have ESG sustainable portfolios as an offering for our core advised portfolios. And so today we're going to go through market insights, a review of the third quarter, review of the portfolios and how they did during that quarter, and go briefly through the market outlook that we have. So with that, I'm going to just flash a disclaimer before we move on. As a licensed MAS financial advisor and CMS license holder, we also have a Slido poll on the side. So please refer to the code here, 553656. You can just type it in and then go in. We also have links below on the YouTube channel. So you can always refer to that. Also, you can book an appointment with one of our licensed representatives who can give you client advice. Human interaction as well as get going with opening an Endowus account with the link below. With that, I'm going to jump right in on a review of the third quarter. So obviously it's been a very, very volatile quarter. It's actually, in fact, the first negative quarter we've seen for a very long while since the COVID pandemic began in March of 2020. So 18 months of relative stability, a lot of noise, but relative stability and decent good returns throughout that period. Almost every quarter, a positive return until this quarter. So some people call it the September effect. Some people say, it's because of these US and Chinese policies, massive headlines that is causing, a lot of concerns, whether it's inflation, whether it's interest rates, where it's headed, the Fed's policy, but more closer to home, the wobbles that we have seen in China with regards to the technology sector, and now the real estate sector, which is in heavy focus. And related to that, the systemic risk that exists in China from a macro perspective because of the heavy debt burden that the economy faces. So if you look at the performance for the third quarter specifically, it is, as I just mentioned, the first time that the quarter, after a very strong July and August, dipped down in terms of performance. So we had some strong negative returns in September that wiped out a lot of the gains that we saw in the early part of the quarter. But there was a foretelling of this correction, and emerging market was the leading indicator. Obviously, China specifically within that, which is a large component of the emerging market index, led that way down with the technology sector first, and then real estate and banking and other sectors as well. But what's interesting is that the fixed income sector, which normally would counterbalance some of this correction, actually had a very high correlation and moved to get in tandem with the equity market. So you see the yellow and the green lines, the yellow line being the global aggregate index, the global benchmark for fixed income, and also the EMBI, the JP Morgan Emerging Market Bond Index, which also saw a correction in September. So there was a concerted move down across asset classes, which is not always normal, but we have been seeing a high level of correlation in recent months and years. Equity market returns, if you break it down by geographical sectors, then obviously, surprisingly, Japan was the best performing market. Year to date, is probably the best performing market as well. But having said that, there's a lot of rotation. We always show this kill chart because of the nature of equity markets and how it's very difficult to predict which is the winner in the next quarter or even in the next year. And so it's always important and to be mindful that it's a futile effort to try to predict the next winner for the next quarter. And it's important to have broad diversification so that you're exposed to the winner every quarter rather than any single quarter. I think that China was front and center throughout the quarter of equity market performance in particular. It dragged down emerging market returns as well as Asian returns. But specifically, you can see there was a divergence where the ADRs and overseas listings, which is dominated by the Chinese tech names, was the first to go. They fell rapidly throughout July and August, despite the rest of the global markets rising during that period. And then since then, we've seen other sectors within China also come off following their trajectory. And so China has been a meaningful detractor to performance, not only in China, in Asia, and emerging markets, but also within sectors, technology, it's been a big hit as well. And that's being reflected by sentiment, and equity inflows throughout the year was very, very strong. So as you can see from the latter half of 2020, when the market started recovering and going beyond the previous highs, reaching new all-time highs, we saw massive influx of liquidity into the equity markets globally. And that continued, and backed by policy with a very loose monetary policy and quantitative easing, we saw a lot of liquidity in financial markets, and individuals who also received a lot of fiscal support. Actually, even in the US and across Asia, you can see that many people actually use those checks to support not only income, but also speculation in financial markets. And so flows have been very positive, but it has come off very sharply in the last quarter. Valuation is something that is always talked about. And when the market's climbing a wall of worry and earnings collapses, what happens is that the price to earnings ratio shoots up. Not because the price moved up necessarily, but because earnings collapsed during a recession or a massive crisis like the pandemic. What we've seen since then is a relatively strong and robust earnings recovery. And so what's happened is that while markets have actually gone up, the earnings recovery has meant that we've narrowed the earnings equity valuation gap so that we are now one standard deviation above long-term averages. And if you use CAPE, which is a cyclically adjusted valuation, then we are about 1.4 standard deviation above. Considering that we've been more than 2 standard deviations and beyond during the tech crisis, tech bubble in 1999-2000, we're not at that stratospheric level yet. And remember that in 1999-2000, a lot of it was driven by price rising very rapidly without any earnings really backing it up. It was backed by eyeballs and clicks rather than any meaningful earnings. Whereas right now, what we are seeing is that valuations are driven by the larger, bigger, better companies, especially the large cap companies, especially technology and growth sectors, but also that earnings has been very strong. So while there's even greater expectations, as you can see, the blue is the forecast, the consensus analyst estimates, but earnings has been quite robust, and you see that numbers have come through. And we're in the middle of the third quarter earnings season, and every other day we see on Bloomberg and CNBC that financial sector, especially banks, outperformed. And then yesterday again, Netflix blew out numbers. We have Tesla coming up. So flagship bellwether kind of companies and sectors have delivered robust earnings growth. Year to date, that number is 26.3% versus the price return of about 14.7% for the index. And therefore, there's been a compression in valuations this year with the earnings recovery. And this is probably the most important thing, that people really do focus on too much on macro. And there are real meaningful macro risks out there. And we'll highlight that. And Wei Mei will go into much more detail as we talk about fixed income. which is directly impacted by monetary policy in particular. But regardless of that, I think equity markets fundamentally are driven by earnings. And when we talk about the S&P 500 or global stock markets, we're not talking about the coffee shop that goes bankrupt during COVID, or travel industry, which is a relatively small component of the global index. We're talking about the biggest and best companies are the largest portion of the equity markets, and those companies seem to be continuing to deliver on earnings. And so it's important to understand this divergence between the macroeconomy, the Main Street versus the Wall Street, where the market indexes are driven by a smaller number of companies. As I showed in this list, the top 10 stocks in the S&P 500, for example, is now almost a third, 30% of the total index, and their earnings contribution is just equally as big, which is very different from back in 1999-2000 tech bubble, where their earnings actually contributed quite little to the overall earnings of the market. So just with the general sentiment that inflation is quite persistent because of supply chain bottlenecks, because of commodity prices, a lot of cost push inflation is baked into expectations, and that's not resolving itself very quickly, and as a result, people are worried about the persistency of this inflationary pressures. And so we are seeing a gentle tightening occurring in, especially interest rates and market yields. So treasury yields in general have started picking up. And we see that, in those type of scenarios, equity markets do not necessarily do badly. What we see is that, especially certain sectors could even benefit, like financial industry could actually benefit in this scenario. And so it's important to understand that not all of the components of the market will be affected negatively when interest rates are rising. And the threshold at which equity markets tend to underperform is when the yield rises above 2-3%, and we are quite a way away from that. And so there is, I think, caution, rightly so, but I think we need to offset that with the reality that earnings are relatively robust, and also rising yields do not necessarily mean that the markets have to underperform. The underlying economic recovery is very strong. As you can see, the leading indicators, the purchasing manager indexes globally on the supply side and input and output prices continue to rise. These two specific, data points is one is on the left side, the supply chain disruptions and delivery times. The right side is, what are the pressures on inflation from rising prices? And both of them have come off a little bit from the peak, but are at very elevated levels, which is a concern because it means that inflation is not going to come off very quickly, and therefore there is a risk to policy and also interest rates going forward. But if you look at the long-term perspective of where we are, and these are headline CPI numbers which are very high, core CPI driven largely by energy more than the staples like food, and the deflator, PCE deflator that we see has picked up a little bit. So you're seeing core inflation, headline PCE numbers, and core PCE numbers, deflator numbers, GDP deflators also, rising a little bit, but it's not at ridiculous levels and not at levels that are beyond, major concerns of, for example, stagflation, which is a major concern in markets right now. Finally, I'm going to just touch on these tilts because our core advised portfolios obviously have certain factor tilts, which are the proven factors of return that over a long period of time should manifest itself in slightly better returns. The long-term trend of growth versus value has been, all about growth over the past decade. And you can see that the numbers still remain quite strong on a 3-year rolling basis, with growth outperforming value. But you can see that small cap has, started catching up with large. And that's because in the past 1 year and year to date even, value and small has outperformed quite meaningfully. But between value and growth, it's neck and neck. But you can see that small cap has outperformed large cap quite significantly with the strong rebound in value as well. But Q3 was a reversal of that. So for one quarter, we gave back some of that gain. But our portfolios in general, even with the factor tilts, has done relatively well and held up better than benchmark or peer performances. I think this is just a reflection of the recent numbers. And from here, I think I'm going to hand over to Wei Mei to discuss the interest rates and the trends in fixed income markets.
Thanks a lot, Sam. So across Q3, we've seen quite rapid movements when it comes to US Treasuries. So as an indicator, just between August and September itself, the 10-year US Treasury yield did go up about 18 basis points. But if you look at where it went from, let's say, the lowest level around 3rd of August, until currently, which is the data point that we put in as of 11th of October, the spike in yields have been a lot more rapid. So it's roughly about 43 basis points. So impact on fixed income portfolios as a consequence of having some duration risk would also be magnified because of this rapid increase in treasury yields. Over to the next page. Let's take a look at how credit spreads have widened now that we've covered how rates have performed. So for the Asian credit market, we certainly had quite a fair bit of widening, both across investment grade and also high yield, predominantly because of the contagion that investors were concerned about coming out of China real estate. And you'd have seen that overall high yield would be more impacted because there's a general fear that default rates will increase from here on, and higher bonds are more susceptible. However, if we move on to the US market, which is the next chart, the US credit spreads have been a lot more muted. So in fact, if you are also diversified into US corporate bonds, you would have seen the US market performing better. Over the course of the last quarter, you would see that levels did move up slightly, but by and large, it's a lot more well contained, and in fact can present good buying opportunities for new investors that are starting to come back into fixed income. Moving on to the next page, I want to reiterate that in terms of overall default rates, currently the levels that we are at is considered to be even better than the 30-year average. So as of end of September, default rates are roughly about 2%, whereas the 30-year average is at about 3.49. And the last we saw in terms of high default rates was in the middle of 2020, right after the COVID-19 sell-off that happened. And the peak levels was at 6.5%. So since then, we've recovered quite a fair bit when it comes to improving recovery rates whenever you have corporate bonds going through more distressed situation. So I would anticipate that we're still going to continue to see default rates remaining at a fairly decent level. Moving on, let's take a look at the different subsectors within fixed income and how they have performed during the quarter. Similar to Q2, Q3 again demonstrated that credit have outperformed sovereigns, and credit by and large would be the higher yielding components that would have outperformed, and that would be in the form of US high yield, European high yield, which continues to dominate. And year to date, the results are fairly similar. The top categories that have generated positive return continues to be predominantly high yield, and sovereigns are represented by US Treasuries, and also to a large extent, EM sovereign debt would be the ones that have a lot more challenging situations, predominantly because they're lower yielding, but also at the same time made up of structurally longer duration instruments. Moving on now to the next page. I wanted to touch on where valuations are for fixed income, because I think this is a key factor when it comes to analyzing relative value. And if we look at levels today versus a 15-year average across all sectors, despite the recent spread widening that we have witnessed in some markets, you would see that we continue to be trading on the tighter end. Effectively, the current levels are represented by the light blue diamond that you see in the table here. And almost across all categories, with the exception of emerging market debt, will you see the diamonds below the 15-year median level, which is more like the 15-year average, right? And overall, you see that it is still considered fairly tight. And to be fair, this is also because default rates have remained low, and therefore the market would still be relatively bullish about overall fixed income performance. But as we get to the later part of our discussion today, I'll touch on more about how we see the impact of rate increases impacting the fixed income market. Okay, moving on. I'll hand back to Sam as he touched on the respective portfolios that we have and the performance for Q3.
Great. Thank you so much, Wei Mei. Great stuff. So we're going to kick off the review of our portfolios and how they performed. Obviously, for those who are new, we have three major sources of funds here in Singapore. We have cash savings that we can invest in a diverse range of instruments. We have CPF, which is a core part of the future retirement preparation that we need to make. And within CPF, there is the CPF investment scheme, which has funds that have been approved and included into the scheme. And so there's a limited selection of funds that we can work with. Endowus has worked with our partners who are global fund managers like Vanguard and many others like Schroders and Legg Mason and Aberdeen, etc., to build a portfolio like the cash SRS portfolio that is globally diversified, geographically, sectorally, for fixed income across different credit spectrums, and duration as well, so that we can build a very holistic, diversified portfolio and offer it at the lowest cost possible. So Endowus is always the lowest cost option to expose yourself to broad passive asset allocation strategies. Among all the robos, I'll show you, how these different strategies have diverged in terms of performance and characteristics. But Endowus is the only one that is offering a truly passive exposure to global markets in its asset allocation. While we use various different funds as instruments and building blocks, we've optimized the portfolio through our algorithm to make it as efficient as possible with low covariance and also, highly broadly passive exposure to the global indexes. So it tracks the global indexes quite closely, as it should. And that has been a positive in terms of performance. This third quarter, after two stellar quarters of performance, generally across all our portfolios, the numbers are largely, surprisingly flat is the number that I think is showing. Like after the volatile moves, we've gone to zero or close to zero on everything. So 100% equities is down slightly after strong July, August, but giving it all back in September is minus 0.2%. This compares to the MSCI All Country World Index of return of negative 0.1. So it's largely the same. And remember, we always talk about the index return without fee deduction, whereas our return portfolio is net of all fund level fees. So this is the actual return. And then you can see that in the middle box, the indexes, you can see how the different indexes have done. So World Index, which is despite the name, a developed market index, is returned 1%. So the developed markets did better. But what dragged the returns down quite a lot was obviously emerging markets. And we talked about China and China technology, etc. So S&P 500 is a US, 30% of revenue comes from global, but largely global US companies. did the best at 1.6%. The World Developed Market Index, because US is such a big portion of it, did 1%. The All Country World Index, which is the most diverse global index, did minus 0.1, which was largely flat. But EM did terribly, and Asia within that, and China within that. Fixed income actually eked out a slightly positive return of 0.1%. And that's a good number because the Bloomberg Barclays Global Aggregate Index, which is in the lower half of the middle box, was a negative 0.5%. So, and even the JP Morgan EM Bond Index was flat at 0%. So our portfolio in fixed income, with some active exposures where we've actively managed the risk, that has actually generated better returns during the third quarter, protecting your capital quite well. If you look at the factors, I touched upon this, I'll be very brief. A small, again, outperformed large for the quarter year to date. These are year to date numbers. And value has outperformed growth, and profitability dragged a little bit among the large cap. So lower profitability did better. So what that means that the market is pricing in a recovery. So low profitability companies, if you expect a recovery, are the ones that will rebound. So we call that the junk rally, or we call it, the rebound of low profitability versus high profitability in the early stage of an economic recovery, which is what we're seeing. But in the small cap sector, it's actually interesting. High profitability, again, remains a better performer. And that's because in the small cap space, higher profitability is higher quality in general. So you want high quality small caps outperforming. That was developed markets. Emerging markets, a very similar thing played out. Emerging market, again, is a higher risk subsegment of the global markets, and therefore profitability and quality does better. So large and small quality, which is profitability, did better across the board, and value and small exhibited itself as a factor outperforming overall. Now, if I move to the CPF portfolio, the CPF portfolio actually, is very similar, again, very flattish, you can see, and some divergences in terms of performance. But, again, equities did slightly better, only falling by 0.1% versus 0.2% for cash. And while fixed income did slightly worse, so it was flat at 0% versus the plus 0.1% for cash and SRS. But again, both equities and fixed income did relatively well versus the global benchmark, which it's benchmarked against. So cash, SRS, CPF, all of the core kind of flagship advised portfolios did relatively well. But the stellar performer for the quarter was actually our ESG portfolios. For those of you who are existing clients, you will know very well by now. But for those who are new to us as a platform, Endowus is the first digital advisor and a wealth manager to provide a sophisticated institutional quality ESG sustainable portfolio. And we have worked with some of the leading proponents of ESG funds, both globally and locally, and launching this and making it available to retail investors at institutional cost, which is the lowest possible. That we are the first in the industry to do so across Asia. So these ESG portfolios have now been live for over, almost 2 quarters now. And so the performance you can see has been, quite steady and strong. And third quarter was once again a quarter where you saw ESG portfolios shining because the sustainability angle has worked in its favor with relatively better risk-adjusted returns. So equities actually was up quite decently, 2.3% versus the flat kind of returns for the benchmark indexes. So it beat pretty much every single index that's out there. And even the fixed income, which traditionally has not given us as a stronger return, actually did very well in terms of protecting capital by generating a 0.2% return. And obviously there's a blend of assets. So you can see how they've done across the board. And year to date, earlier in the year, it was lagging the returns a little bit, but it's caught up very quickly with the third quarter outperformance. So it's now in line with MSCI All Country World Index returns year to date. And the fixed income portfolio has now done better than the index and is the only one that's in a positive territory year to date. But the other exciting thing that I want to highlight is how Endowus' portfolio and our broad passive strategic asset allocation has done against not only the benchmarks, but also the other robos out there. So as you can clearly see, this is a posting by an actual client who has an account with Endowus, has an account with Saif and Stashaway, the two other robos that are quite prominent. And so he has compared his actual returns versus our competitors in the robo space. Obviously, there are a lot of other competitors, DBS, Robo, and a lot of other products out there. But specifically for the Robo product, I think it's really important to understand that being passive and strategic in our asset allocation has worked well for our clients. And we have significantly, massively beat our competitors in the Robo space. And even against benchmarks, once again, because we're globally diversified, we are largely tracking the MSCI All Country World Index, which is the broadest measure of index. MSCI World, the developed markets did slightly better, but not too shabby. Endowus net of all cost has done quite decently tracking even the developed market returns. And again, comparing MSCI Asia ex-Japan and even the local Singapore Stock Exchange returns, Endowus' 100% equity portfolio has done relatively well. And the client obviously is in 100% equity, and comparing our 100% equity to Saif and Stashaway's equivalent highest risk portfolio. But the fixed income portfolio has actually outperformed even more versus our competitors. And so it's important to understand that across the asset class, across mixed assets, Endowus would have performed significantly better. And one of the main reasons is because the other robos actually have a relatively active asset allocation strategy. So they buy and sell. And Stashaway in particular obviously had a massive overweight in Chinese technology. So they sell US, buy Chinese technology, sell Europe and buy gold, and they keep actively moving things around, and they double down on Chinese tech after it started falling, for example. And these are all very active bets. And while they say it's driven by algorithms, I think there's a lot of human input in that decision making, and that's really causing the performance to drag quite a bit. And this is Investment Moats, our friend Keith's publication. He publishes a similar exposure that he has across the various different portfolios. So not only Endowus and MoneyOwl, which again is now, MoneyOwl and Endowus has very similar strategic asset allocation. And so it tracks the benchmark quite closely. But every other robo portfolio, whether it's the Saif 100 equity or the ARI kind of risk adjusted one, Stashaway's portfolio, or the REITs portfolio has been a terrible performer. But all of them in comparison has done relatively poorly over a longer period of 1 year. The previous table was a year-to-date comparison. So once again, Endowus' portfolios are strategic asset allocation. It's a passive asset allocation. It gives you broad exposure to globally diversified markets and sectors. And that is the right way to invest your long-term investments. Finally, I'm going to touch upon cash smart and defensive portfolios, because there's been a lot of questions, and I see in Slido, I see a lot of questions on cash smart, why Ultra has fallen. I would like to refer to the cash smart article that has just come up. So Anonymous's first question, why did cash smart Ultra fall so much? Our moderator has responded with a link on the Endowus Cash Smart review update. So we have a monthly review for Cash Smart that we publish, transparently showing exactly what the performance has been, what is our monthly return, and trying to explain to our investors why the returns have been negative. But obviously it's a 1 month return that's negative. The quarterly returns across all of the Cash Smart solutions have been positive, and since launch the numbers have been quite stellar. But obviously the volatility has returned, and if you look at this number on a monthly basis during the different periods, year to date, quarterly, since inception of January 2020, longer periods, you can see Generally, there is a trend that ultra does give you higher returns and then enhanced than core, but that's starting to break down this quarter and this month because obviously the rising interest rates is providing a lot of volatility. You are exposed to a longer duration with the ultra because you're in short duration, whereas cash smart core is really very short duration within a few months. And you're exposed to institutional deposits rather than fixed income instruments. And so it's not affected by duration and the movements in interest rates. So core has been the steady one, eking out obviously a positive return. It's typically going to give you 0.05 to 0.07% every month, and that should compound to a 0.7% to 0.8% type of return annually. Enhanced should be giving you something closer to 1% or above over a 12 months period on a rolling basis. And ultra should give you higher yield over time, but obviously it's exposed to more volatility. And the chart above exactly represents this. Core is a very steady line of virtually 0 days of negative return. So if you're worried about volatility and losing money and you want to protect your capital and yet generate much higher returns than or yield than bank deposits, then the core is the way to go because you're going to get much, much higher than even 1 year fixed deposits. But if you want enhanced and ultra, then obviously as you take more risk, as you go longer out in duration, there will be volatility. And this looks like a massive move, in cash smart ultra volatility. But really, if you look at the left y-axis, is actually a move from 100 to 104, 105. And if you compare this to the actual, fixed income exposures, then this chart clearly shows how cash smart looks versus the ultra defensive portfolio and the 100% fixed income portfolio. So the 100% fixed income portfolio, which is much more defensive than anything with an equities exposure, 100% fixed income, is obviously more volatile than any of the cash smart solutions. So you can see that while ultra looks very volatile, it looks largely kind of flat versus what ultra defensive or 100% fixed income does. And across the range, you can see that in a scenario where interest rates are rising and bond prices are falling, and there is a mark-to-market loss incurred in fixed income, then the duration becomes probably the most important factor in driving short-term positive or negative returns. But I highlighted in that scenario what ultra cash smart ultra looks like because of the different components. It really actually was one fund out of the 5 that we have in the ultra portfolio that gave that negative return. The total return for everybody else was positive. Nikko Asset Management Shenton was the one that had that impact, and because it's an income product, the mark-to-market impact was bigger. And once again, the biggest reason for that is because it has the longest duration. So whereas the Line Global Enhanced Liquidity would be 0.7, PIMCO, for example, low duration is 0.85, less than 1 year. And that's offset by some longer duration, short duration funds like Fullerton and Line Global, which is around the 2+. Nikko is the only one that has a 3.85 duration. So duration means that for every 1% move, there will be a 1% fall if duration is 1. So if there's a 1% move, then there should be a negative 3.85% move in Nikko Asset Management Shenton. And that's why the negative drag in returns. And also, I think there was a massive impact from the China exposure that it has. If you combine with Hong Kong, that's almost 40% of the portfolio. And again, it has quite a lot of exposure in real estate, which has been heavily impacted. So China, real estate, Evergrande, Huarong before that, a lot of this thing got concentrated into the Nikko Asset Management fund. And therefore, it's dragged down the performance of Ultra. Having said that, it is a diversified portfolio. We had tried to limit exposure to a single fund because of these kinds of concerns we have. And as a result, we've mitigated some of the losses of a single fund underperforming. But we also realized that this is a short mark-to-market return. Things could recover. For example, if China rebounds, if Evergrande does not get impacted, then the China real estate sector could rebound very sharply. Also, interest rates could move in a reverse direction. For example, if inflation starts coming off or concern starts dissipating about an aggressive Fed move. So we cannot predict the future, but there is underlying positive sentiment with a hopes of a China recovery. Also, even if interest rates continue to rise, there is a flip side to the negative, that it's a short-term negative because there's a mark-to-market loss, which is not realized. And if you hold on to it, then obviously most short duration income and short duration funds would hold all of their fixed income and bonds to maturity, and you will get back the original par value, which will mean that you will mitigate any mark-to-market losses or temporary falls in bond prices because you're going to be marked back to par at maturity. But when that maturity happens and you have money coming back, then you have to redeploy that as a fund. And when you redeploy it, the market interest rates have risen and you're able to redeploy it at a higher interest rate. And so longer term investors actually benefit because interest rates are rising and you're able to generate higher yield off of that. I spent a lot of time explaining the cash smart because it is a hot topic, is something that a lot of people are concerned about. We did what we could to build the most robust, diversified, short duration, exposed, and higher yielding cash smart solution because our clients requested it from us, and we've had tremendous response from our clients. We are extremely sorry that the market conditions have impacted your returns, but it's really important to talk to our client advisors and also look at our reports and our monthly publications and really keep abreast of what's going on in markets and also your portfolio. And it's important to assess your risk appetite and really place your money and your investments in the appropriate risk levels that you can stomach. And so if you think that you want to protect capital, if you want to not take as much risk and not get as much yield over the long term, then you should not be in Cash Smart Ultra. You should be in Cash Smart Enhanced, or you should be in Cash Smart Core. We have intentionally created 3 different risk profiles, 3 different products in Cash Smart with differing yield expectations, transparently showing that every month, every week, we get that updated from the FMCs. We're the only ones among robos that transparently share all this information with our client base. So it's important that our clients also help us by really keeping abreast of what these products are. We've emphasized these things and the risk associated with Cash Smart Ultra in the past. And so we hope that we can continue to improve transparency, communicate with our clients, but also offer the best solutions that's available for our clients. With that, I'm going to pass on to Wei Mei for the Q4 outlook.
All right, thanks, Sam. Now moving on to what we can anticipate for the fourth quarter. I think first of all, it's important to take note that broadly speaking, across different indicators such as economic activity, inflation, and also where central banks are looking at for their monetary policy, it is clear that we are in the mid-cycle of the recovery. And at this juncture, we should be expecting that in terms of economic activity, the trend will still be fairly strong. At this juncture, it's pretty much the supply chains that continue to have difficulty. But having said that, there's a lot more normalcy that's coming back with more of the economies across the world opening up. As for inflation, I think key question is whether is it going to be persistent or is it going to be transient. I think by and large, the Fed has also come up to say that they are expecting it to be transient. It should normalize going into 2022. I think the elephant in the room is really about how energy prices might change things altogether and cause inflation to be more persistent than what the central banks are expecting. But overall, across the board, monetary policy remains easy. So you're not having a numerous number of central banks trying to tighten up policy. Fed is probably going to be one of the first, but even then, in terms of magnitude, it's going to be relatively benign from how market investors are factoring in right now. Moving on, let's just take a look at oil prices, because across the board, as we've seen over the last couple of weeks, we have, be it crude oil prices, coal, natural gas, you have seen the numbers spiking up. And the question is always whether we are starting an energy crisis. And if we do have energy crisis, does that mean that growth will definitely slow down? I think we have seen that in certain countries, for example, China, factories are starting to cut back on production because they don't have electricity supplied to them. They cannot continue working through the night. And there is going to be some short-term impact. And of course, as we get into the winter season in the Northern Hemisphere, this seasonality effect is going to set in further. So I think overall market participants are pretty mixed in terms of how they see it. There are certain houses like Goldman calling for overall repricing when it comes to energy prices, and that we are going to go into a new normal, which is that energy prices will remain elevated. And that's because supply is limited, and supply across the board from all the different sources that you've seen is not going to be elevated in the short term. So that's something that I think is worthwhile considering. But in the meantime, I don't think we are expecting another recession to come in as a consequence of energy price increase. Moving on now to the next page, I wanted to share an institutional fund manager survey, and there are about 280 participants on this survey, and this is done by Bank of America. This is just hot off the press, and it's really interesting that for institutional fund managers, they continue to consider inflation to be the biggest tier risk when they are being surveyed on what could be the key issues that would suppress growth. China has also suddenly come into the picture. Compared to September, China wasn't even in the top six. And China is now ranked number 2 in terms of a particular area that could pose quite a bit of concern. And interestingly, in terms of the COVID-19 Delta variant, we have spoken about it for the last 2 quarters. This time around, you will see that most managers are now less concerned about it. And in fact, it has dropped down in terms of its ranking. Next thing that I think we can look at on the next page would be overall sentiment as well as positioning. So in terms of what's likely to happen if the Fed were to taper in November, most of the institutional fund managers are expecting higher market volatility, and I think this is fair. The key indicator that they are looking at here would be the VIX, the VIX. The second one would be in terms of a stronger US dollar that could come in as a result of Fed tapering. And the third thing would be effectively wider credit spreads that's going to happen. And that's predominantly because you're going to find that it would be more expensive to also borrow as well for the corporate issuers. So you should be expecting wider spreads in order to compensate for the higher coupons that they have to pay. And Sam has switched his screen. So I'm just going to go to the right-hand side. And the right-hand side has got a chart on positioning. Because the key question is, what do you do if there's going to be more volatility and going to be more inflation? And institutional fund managers have repositioned some of their portfolios. And this is relative to what is the average that they have done over the last 10 years. So I think it's a good indicator on some of the rotation trades that are going on. It's predominantly towards buying inflationary assets, things that could hedge against rising interest rates and rising inflation. And that would be commodities as well as bank stocks. It could also be bank subordinated debt. However, the underweights would be in areas such as broadly fixed income, emerging markets, and also utilities. So it's quite a divergence, as you can see here, but I think it's interesting to see how the institutional fund managers are placed right now as they try to think about what's going to happen in the next couple of months. Moving on, let's just take a look at the highlights from the most recent FOMC meeting. Overall, the expectation here is for tapering to start around November. And I think this is the market consensus, and we're not going to argue about it. I think it's going to be November or December, not too far from that. But what's really important is when the first rate hike is going to happen, and what's the magnitude of it. Overall, it should be coming in at 25 basis points for the first rate hike. Looking at the dot plot, the Fed officials are generally divided. The consensus is for it to happen in the Q4 of 2022. So we're still about 12 months away from the first rate hike, but as always, you should be anticipating that the market will price in a rate hike before it actually happens. So when it is finally here and the rate hike has come in, then in fact there's a higher probability that markets will rally and fixed income will actually recover. So it's a little bit contrarian. It doesn't mean that markets will only decline when the first rate hike sets in place. And that's why a lot of people monitor the Fed funds futures and look at the forward curve in order to determine what the market is pricing in at this juncture. So no surprises there. As we moved on to the next slide, I wanted to highlight where we are in terms of default, because default is usually a precursor of what is to come. Because as more companies start to default on their outstanding liabilities, then obviously it is a sign that we're going to be going to a period of slower growth and potentially have a reversal and a recession could set in again. But what we're seeing right now is that for the third quarter of 2021, defaults have been very limited. There were only 12 defaults that were registered by S&P. And overall, there is still a lot of liquidity in the market. And I think that would be an important factor to support companies and ensure that they can continue to obtain leverage. And business conditions will certainly be improving from here onwards. Looking at the next slide, the other factor that we have been looking for will be projections. And S&P has projected both a base case, optimistic and a pessimistic scenario on broadly US higher default rates, because I think this would be the most liquid of all the higher markets and therefore also indicative in terms of a broad spectrum of companies that they are monitoring. So as of end of June, the numbers was at 2.5%. And even in the worst case, which is the pessimistic scenario, the expectation is for defaults to creep up to 5.5. So it's not going to be suddenly we're going to see like a double-digit number that's happening. So I think we should take comfort that we're going to a period where there's also less of a need to get too angsty about a potential slowdown or even a stagflation scenario that could take place, which will certainly make equity markets more jittery and more volatile. All right, then on the next page, I want to touch on China. China is an important one because I think as we started the discussions today, we've talked about US and China being the two key markets that have moved Q3 performance altogether. And China, what we are seeing here right now, it's a market where it's driven by a lot of regulatory changes. It is policy driven, and we should expect this to continue. But the key driver of China GDP growth has always been consumption. And you do see that very strongly in the gray bars that's represented on the left-hand side. The gray bars literally show you that consumption has constituted a significant portion of GDP versus that of investment or exports. And it has been the same scenario for Q2, even though China was starting to see a bit of a slowdown. And we expect that from the monetary policy side, the reserve requirement ratio will continue to be kept fairly low. There has been, of course, two camps. One saying that China Central Bank, PBOC, would not cut it further from here onwards to the end of the year. but they will use other measures, especially other forms of adding liquidity into the market that can help support capital growth. And with the fiscal deficit continuing to grow, you can also take comfort that the Chinese government is prepared to spend and carry on having a fiscal deficit just to be able to boost the economy. So I think it is running on a twin engine of both a loose monetary policy as well as fiscal stimulus. And with China, I think the other thing that I would want to take note of is on the next page. And here we will see how China has dominated the overall global capital markets. So while many may say let's avoid China for now, it is now, I think, extremely painful to just say I don't want to allocate to China, I just buy to US and Europe and so on. Because just looking at the MSCI Emerging Market Index, China A shares have been included in there since 2019. And the share of China has increased over the last 2 years from 32% to 38%. So if you are effectively going to be buying into emerging markets, you do need to have China. You can't possibly exclude almost 40% from the index. And this is the same for institutional managers who are benchmark oriented and have to buy in accordance with more or less the benchmark exposure. Within fixed income, you're looking at the bond universe overall, and you can see the China exposure, be it in global aggregate or be it in terms of, let's say, local EM debt sovereign exposure. It is generally in the double-digit range. So at about 10 to 14% would be the number that you're looking for. It is not small, so it is also necessary to have China bond exposure. Even with the recent sell-off, we are not seeing investors exiting China fixed income altogether, because with any crisis, there's always going to be good companies that are being sold off in the same magnitude as the lousy companies, because it's just a blatant risk-off scenario. But in this kind of market, I think the good companies will continue to prevail. And it is important to continue to have Chinese allocation, be it across equities or fixed income. The other part that is worthwhile noting would be the next slide, and that will cover default rates. Because today, given the aggressive sell-off that has been happening, the market has already priced in a much higher default rate. And you will see from the table here, there's a large percentage of bonds that are trading below 50 cents to the dollar. And it's more than doubled from, let's say, 1 quarter ago. So it is definitely pricing in something a lot more aggressive than I think what the reality will eventually unfold. And for investors who are more opportunistic, going to the China market right now might actually be the right thing to do. Okay, so enough on China. Let's just look at the impact of interest rate increases and what it would do for your fixed income position. So I've highlighted on the left-hand side a number of different subsectors. And you will see that year to date in terms of return, convertibles, US higher asset-backed securities, and also floating rate securities have generated a positive return in absolute terms. So what I'm saying here is that even as we see 10-year US Treasury rates increasing quite rapidly, it doesn't necessarily affect all sectors. And it will be a sweeping generalization if we think that we should exit fixed income altogether, because there will be some bright spots, and it will be important to be selective. It is true that with longer duration position, you're going to have more immediate mark-to-market impact. And on the right-hand side, you can see the impact of a 1% rise in interest rates and what it would do if you were holding to the different sectors. Case in point would be a 30-year US Treasury instrument. This is the super long duration one. And when that happens, you can see that in terms of your price return or your total return, you're going to be down anything between 17 to 20%. So it is quite a big number to look at here. But again, if you look at sectors like convertibles, if you look at US higher, you can get a positive total return. So I want to differentiate between price return and total return. because effectively price return is just going to be what you would be seeing your price level of the bonds changing. But if you are receiving a coupon, the coupon does compensate for some of the price decline. So actually total return can still be much better off as a metric. And that's also why bonds with a higher coupon right now will tend to outperform. And I think that's also the reasoning, because you can see it from the numbers that total return would be a lot more beneficial. But you do have to take note that with longer duration risk, then of course your mark-to-market impact in terms of price decline will also be more significant. And it's something that you'd have to be willing to tolerate. But given that defaults are going to be relatively more minute, as long as you hold it to maturity, more or less, I think things will recover, and you will be in fact in an environment where there will be higher coupons that you can enjoy, because we will be in a higher interest rate environment overall. On to the next page. Let's just take a look at what equities will happen as rate increase. And with a rate rising, we can look at different time frames. Going back to 1965 until 2009, which was after the global financial crisis, stocks and rates would move in tandem until you have interest rates rise up to about 4.5%. And later on, post the global financial crisis in 2009 up till today, stocks and rates will rise together until you see interest rates at about 3.6%. So while the absolute magnitude have come down slightly, the trend is the same all throughout this year back to 1965. So we should be expecting that equities will continue to outperform as interest rates increase, but it cannot be a crazy rise in interest rate. More recently, we're saying that as long as interest rates rise up to a maximum of 3.6%, this correlation pattern should hold, and we should still be expecting equities to generate positive performance, and the higher rates will not curtail the performance or the earnings recovery power that would be demonstrated. On to the next slide. Let's just take a look at correlations, because correlations is going to be helpful as you construct a portfolio. And I want to emphasize that there are always bright spots. This is a measurement of correlation across different asset classes versus S&P 500. And S&P 500 is used as the equity proxy here. Most of the asset classes are not going to be having a very strong correlation with equities overall. Even with higher yielding sectors like emerging market debt, the correlation is roughly about 0.7. And if you're looking at other areas like mortgage-backed securities, it's in fact negatively correlated to S&P 500. So you don't necessarily always have to allocate to government bonds, which are the least correlated. But if you do allocate to government bonds, you can also take comfort that this is the sector that can help you hedge out the most in terms of, let's say, protecting on the downside. Because if we do have a crisis that can suddenly crop up in the market, then your portfolio is going to be most well protected if you have government bond exposure, and can help cushion the volatility versus equities. In the meantime, I think somewhere in the middle ground would be useful, and to be broadly allocated to different sectors. Even areas like real estate, infrastructure can help you. These are the higher yielding sectors, but with relatively low correlation, if not negative correlation to S&P 500. So it's really interesting to just take a look at some of the correlation effects here, because by selecting different subsectors and building your portfolio accordingly, you are going to be optimizing the outcome that you're going to have by having a better risk-reward ratio compared to just being all out in just one single asset class. And finally, I want to share with you what has happened since the COVID-19 sell-off in March of 2020. So at that juncture, if you look at the top chart, what happens is that S&P 500 would have declined the most, and it took S&P 500 the longest to recover. You had to wait until around August of 2020 to recover. But if you were in a 40-60 portfolio or a 60-40 portfolio, either permutation would have allowed you to recover earlier than being fully invested only in equities. And I think this continues to hold true if we look back at a 20-year horizon, because what we see is that as an average investor, it's always difficult to outperform the market. So it's much better to stick to your strategy asset allocation. And if you were in a 60-40 or 40-60 portfolio, for that matter, split between equities and fixed income, you would have generated much higher returns compared to an average investor. And I think this is well proven that it's important to keep to what you believe is your long-term objective and not let the short-term market volatility tempt you to make changes to your longer-term strategy asset allocation. I think this is also one of the questions that I've seen on Slido on whether there's a need to reallocate right now. My answer is no. You should not suddenly reallocate unless your personal circumstances have changed quite a fair bit, and you may need some more liquidity, etc. But by and large, if everything stays the same, then the current September sell-off should not impact your decision to switch asset allocation immediately. So with that, I'm going to hand over to Sam, and we can take some questions.
Sure. Thank you so much, Mimi. That was wonderful. And I'm just looking through the questions on Slido, and largely I can bucket them into maybe about 4 different buckets. One is quite cash smart, a lot of questions, but we dealt with most of the questions. And so, maybe, and Wei Mei touched upon the outlook for fixed income and cash smart portfolios in general. So, maybe just to add to that, obviously, as interest rates continue to rise, if you're exposed to duration, then you're going to continue to see mark-to-market losses. What's important in fixed income is that, you are investing for the long term to generate the yields. So the duration is, if you hold for that whole duration, then you should never be generating a negative return in fixed income. The only way you're going to generate a negative return is if you lock that in. Or you're actively trading the bonds in and out, which is a lot of active fund managers would do in fixed income and locking in the losses. But you hope to do that by investing in higher yielding, better fixed income. So there is a risk at the near term that with this volatility in interest rates, there is a risk that you lock in losses in fixed income. But over the longer term, over 1 year, 1.5 years, for even 100% fixed income portfolio, you would never really lose money. Is what the average return in fixed income historically has generated. Now, the second set of questions is really about what the market is doing. So there's questions about, the market is starting to drop. What should I do? Should I shift my, portfolio, as Wei Mei just highlighted? Or, valuation questions. We're at peak valuations. What do we do? Are we at all-time highs? This kind of question about whether we should be more conservative because markets are high or valuations are high, or we think that markets have started to come off or it's going to come off more. Should we become more conservative? And I agree with Wei Mei's assessment that should not be affecting your portfolio, because your portfolio is built to last for the long term. And you've chosen that portfolio because we've assessed that is your right risk appetite. Now, if you have overridden our advice and have selected a much more aggressive portfolio or a much more conservative portfolio, then this opportunity may be an opportunity for you to reassess what that appropriate risk portfolio risk appetite is. So you might have chosen Cash Smart Ultra blindly because it was a higher yielding asset class, because you thought it was going to be a free ride. And it would have been, and it has been in the past several years. But March 2020 was a hit. 2018 was a hit. Again, September of 2021 is a hit. And so, these things happen. We always advise Cash Smart Ultra should be held for at least 3 to 6 months. Core, you can hold for 1 month and still generate a positive return every month. But for Ultra, you may need to hold it because we did the analysis and we looked at what is the worst outcome. So the biggest drop from peak to trough in Cash Smart Ultra portfolio, and it took almost 6 months for it to fully recover. And that's why we say 3 to 6 months. And then we cannot always be so conservative. So we have to give a range, and the worst outcome cannot happen every year. So that's why we say 3 to 6 months is appropriate. But if you go beyond 6 months, it's very rare for Cash Smart Ultra to be losing money. And for 100% fixed income, that period is about 12 to 18 months. You would never really lose money because long-term fixed income will generate a certain amount of yield that will offset some of the mark-to-market losses. But overall, I would point you towards an article that I wrote, Will the Markets Always Go Up? So does the law of gravity apply to financial markets? So what goes up must come down is a phrase that we use a lot. Every year there's an intra-year correction in the markets from 4% to 10% to 20%. But every single year in the past 13 years, except one, 2018, where we saw a negative 4%, for the full year we ended up being positive. So, third quarter is a risk. Fourth quarter, we don't know what will happen. But if you read that article, then I think it will help you in assessing what is the appropriate risk for you, what we should be thinking in the long term about when markets are reaching all-time highs and why markets continue to give you returns over the long term. And then the next question is on the upcoming income portfolio. So there's a lot of questions and there's a lot of interest, it seems like, on income products. We are very hard at work in building this income portfolio. Wei Mei and the team have done tremendous work to research and build a very unique product. So thank you for your interest and please look out for it. It's going to take a little bit longer than we had anticipated. So we have to apologize to everybody that it's taking longer than we had anticipated. But hopefully we will be launching an income product that is very high quality, secure. We'll give some choice like Cash Smart so that you can find the appropriate one for you. And we will allow distribution as well through dividends and income dividend distribution. So you'll be able to generate income if you so choose. You can always reinvest it as well if you would like to over the long term, or choose an accumulating share class through our FundSmart platform. But we will make it much more flexible and we'll have those income portfolios. We'll also be launching satellite portfolios as well. So there's a lot of new products and solutions that we are working very hard to launch in the near term. And then the last question is on core versus ESG. So, I can answer this, and Wei Mei, you can answer some of these questions as well in your way, and some of the remaining questions on Slido. But for me, ESG is a core portfolio, but it does not replace the core flagship portfolio that we have for SRS and Cash and Core and CPF. Those are broadly passive market exposure. So it's a very diversified exposure. So you hold tens of thousands of companies in that portfolio. The ESG portfolio is a much more active portfolio. It is a much more concentrated portfolio. So sometimes it may result in higher volatility. But what the portfolio is a reflection of a certain value. If you as an investor think that these environmental, social, and governance values are important to you, then as a value-driven investor, you should allocate a certain portion. And that portion, again, is a very personal choice. It may be 10% that is appropriate for you. It may be 30%. It may be 50%. For some people, they might say, I'm going to put all of my money in ESG, 100% of it, because I really believe in it. What we have tried to do is build a portfolio that is very similar to a core allocation. So it is replaceable, but it's not the same. So it's a globally diversified portfolio. It is a passive strategic asset allocation. It is an active portfolio that is giving you exposure to ESG, but it is a globally diversified and passive asset allocation. So as the returns have shown, it's been tracking the global index for equities and fixed income as well. So that's what the ESG portfolios are supposed to do. And it's given us good risk-adjusted returns since launch and historically in our analysis. Wei Mei, any questions that you want to take?
Yeah, I think a couple of questions regarding what's the expectation in terms of the return profiles in the coming quarter. I mean, I wish we had a crystal ball and we could tell you exactly how many percent it could generate. But having said that, we do believe that the current sell-off that you're seeing is probably not really sustainable. And in fact, we don't believe that there is going to be more systemic risk just coming out from China and affecting the rest of the markets. So to be fair, we're not saying that we suddenly are going into a crisis mode and therefore return expectation will drop drastically. In fact, I think our philosophy has always been not to time the market, right? And I think it's about making sure that you are staying invested for a much longer term. With solutions such as CashSmart, we don't see default risk creeping up, which is why I also anticipate that you shouldn't be seeing, let's say, more negative returns creeping in because we have got default scenarios. In fact, most of the bonds are very short term. If you hold them to maturity, technically they should be returning the full principal amount, and you're giving the managers the opportunity to buy higher yielding bonds. And because these are very short dated products, the turnover is also much higher. You will see portfolio changes a lot more rapidly. So I do feel that it's something that you should take comfort. Our projection for cash smart solutions remains within the range. We've slightly increased it for enhance as well as ultra because with spreads widening, the yields are definitely higher as well. So I do feel very comfortable that we'll continue to be able to generate the projected yield that you're seeing right now. There are also questions related to Asian high yield. That's a good time to start ramping up. I think this really depends on your own risk profile and tolerance. If you are quite risk taking, I would agree because for the Asian high yield bond funds, on average, they are down about between 5 to 10%. It really depends on how much China exposure there has been, but it would have been down quite a fair bit. So if you would ask me from a valuation standpoint, does it look cheaper? Yes, it has definitely retraced from the tightest level that we have observed more recently. And any question is you need to look at some of the top 10 exposure in the fund because I also don't want you to come back and tell me why is there another Chinese property name in there. Because as you look at those funds, you should be cognizant about what you're buying into. If you want to go in on a more opportunistic basis, then quite clearly you can also expect that some of the China names could potentially present some challenges. Just on Evergrande itself, they have up till 23rd of October to repay the coupons that have been due a month ago. The 30 days lapse time will finish in 3 days. So the question is, are they going to pay the coupons that are outstanding? Truth is that nobody knows, right? And a lot of the restructuring discussions are still ongoing. But the Chinese government has obviously said that a lot of the risks are controllable. So we also are not expecting spillover effects. But I would caution in terms of making sure that you're aware of what you're buying into before you actually go in and put the money to work. I know it looks attractive, but bear in mind it's something that you should consider versus your own risk profile. And Sam, I think there's a question on tech, whether technology is the right place to be in, given that there have been recent sell-off.
Yeah, I think the question was specifically on China tech, and if we're trying to predict the future again on China technology, especially when it's not driven by fundamentals of the companies and driven by policy risk, it's very difficult to ascertain, what the right appropriate valuation level that we should be setting for Chinese technology. One thing that has become clear is that, there's clearly a favoring in the market that US technology, despite some regulations that may come for individual companies, is a much more freer market where companies are able to execute, source talent globally and really enter the markets globally as well. So it's just a bigger addressable market with high quality execution, and so if you can gain exposure to US technology or global technology leaders, then do you really need Chinese tech companies, which is pretty much the dominant players in only the domestic market of China? With China economic growth slowing now, and consumers and overall indebtedness rising, there are concerns about the systemic risk in China, and policy risk is part of it. Having said that, the long-term secular trend of Chinese technology obviously is positive. But as I said, how defensible is that earnings? How stable is that earnings? Is it going to continue to grow at the pace that we expected? Is this policy change fundamentally change the way we value Chinese technology? Those are philosophical questions that will be answered over time. But for now, I think most important thing is to be aware of those risks and not blindly follow it. Somebody asking you to buy Chinese tech at this point because it's fallen a lot. And I think that's the wrong reason to be buying anything just because it's fallen a lot, because any company, as we have recently found out, can go to zero. So there's a long way to go to zero for a lot of these companies. If for example, a company gets taken out by Chinese government, but that's an extreme case. I would like to just generally say that technology is a sector that will continue to innovate. There will always be winners and losers in technology as well. So you have to find good fund managers who can sieve through the good versus the bad. Wei Mei and the investment office and the team have worked really hard to curate some of the best technology funds in the business. BlackRock's World Technology Innovation Funds as well, and that's on FundSmart. And as many of you may know or may not know, Endowus, with our price cut, is now the single, when you're buying a single unit trust, it is the cheapest platform in Singapore. It's cheaper than, DBS or any banks. It's cheaper than iFast Fund Supermart, Doladex or Poems for, almost 90% plus of all the funds that are on our FundSmart platform. So please check it out. There was also a question about, whether ESG is going into CPF. We are not yet ready to launch an advised portfolio because the selection of the building blocks to build a diversified portfolio is not there. But on our FundSmart platform, once again, we have the Schroders Global Sustainable Growth Fund, which is an equity fund, which is great performance. For those of you who are religious, there's a Franklin Templeton Sharia Global Equity Fund, where you have to maybe sacrifice returns a little bit for exposure and to be Sharia compliant. But for our Muslim brothers and sisters, Sharia Global Equity Fund is available in CPF. So there are ESG sustainable portfolios and Sharia compliant funds as well available. And we're working very hard to bring more products in. And when we have the full suite of products, we hope to have an ESG advised portfolio for CPF as well. Currently, it's only available for cash and SRS. With that, we've actually gone way over our time. Wei Mei, is there any last question that you want to answer? If there's not, we can just wrap it up today. I do want to say that actually, I clicked on a news because on our company Slack channel, somebody put up the news that unfortunately the current restrictions are going to stay for another month. So the extension of the measures will go on until 21st November and not end on 25th October. So that's why I was like, oh no, and then I clicked on it and then it took over the screen. So I apologize for that. But Wei Mei, any last questions, or have we answered most of it?
I think maybe just one quick one around exposure to large cap. But our core portfolios have a lot of large cap exposure. I think for the cash portfolios, Dimensional would actually have a stronger small cap bias, and the Infinity 500 would have a large cap bias. So overall, I think it will complement each other. As we go into the CPF core portfolios, there is also no explicit large cap bias because we do have other funds that's more focused on emerging market and so on, which multi-cap or all-cap portfolios rather than having a strong large cap bias. So I hope that answers that question that came along on Slido.
Great. I think we should wrap up here, and sorry to be bearer of bad news that the stabilization phase, as we call it, is going to be extended to November 21. Just more time for you guys to join more Endowus webinars live. So please join us in our upcoming sessions. We have some exciting ones coming up. We'll be in touch through Eventbrite or through our communications. You can always click on the subscribe button on the YouTube below. So please, and then we'll send you an invite every time there's a new event that's happening. So you can keep in touch. But with the new rules, very disappointed, but please keep safe, stay healthy, spend quality time with your loved ones. And, with the new vaccinated travel lanes, I think more people are going to be like traveling over the next few weeks and months. So enjoy that freedom and stay safe. Thank you so much for joining us. Wei Mei.
Thanks, everyone. Have a good evening ahead of you.
Okay, wonderful. Thank you so much. Take care. Bye.